The Certified Wealth Strategist presents Tactical Strategies Now podcast series. Traps for the Unwary, Ownership and Beneficiary Arrangements. In the next few minutes, Jeff Cobb, with over 17 years' experience as a wealth advisor in the insurance industry, will share with you some valuable strategies and information that you can use right now with your clients.
The majority of our clients spend a lot of time and money working with their attorneys to have wills, trusts, and other estate planning documents prepared. As advisors, we often participate in the process by bringing tax strategies and planning ideas to the table. In the middle of all this complexity, it's easy to let the simple stuff fall through the cracks. But unless property is properly titled and beneficiary designations are coordinated with those fancy, expensive documents, the best laid plans can be a waste of time. Keep in mind that wills and trusts do not affect the disposition of property passing by operation of law or contract. Consequently, qualified retirement plans, IRA assets, life insurance, installment contracts, annuities, they all pass outside of the provisions of even the most well-drafted wills and trusts. Similarly, property owned in joint tenancy with rights of survivorship or as tenants by the entirety with a spouse escape the probate process. To add some substance to theory, let's look at three concrete, real-life examples of how failure to follow through on the details of retitling property or coordinating beneficiary designations can lead to problems. We'll also consider how to make things right the way they were planned. Retitling assets disposed of in a living trust. The first trap involves an aging client whose living trust was drafted with at least two purposes in mind. First, the client wished to have the trustee manage certain assets during his lifetime, and especially in the event of incapacity. Secondly, the client wishes to have the trust serve as a pour-over instrument to handle the disposition of assets passing at death. In order for the trust to be effective during the grantor's lifetime, and to achieve the purposes for which it was created, someone has to follow through and proactively assure that the assets that are to be managed by the trust during the client's lifetime are transferred to the trust. In the case of real estate, this means transferring property by deed and recording the deed, usually with the county recorder of deeds. In the case of investment assets, it means changing the name of the account owner to that of the trust. Transfer of tangible personal items such as jewelry, artwork, or collections should be evidenced by physical possession by the trustee and appropriate written documentation of conveyance, which may vary based upon jurisdiction. The problems happen when there's no clear understanding of who's to handle the retitling of assets, the attorney, the client, or the advisor, and when the transfers are to be completed. To avoid these issues, make sure there's a clear plan of action following execution of the trust. Assign tasks, due dates, and follow-up meetings. Don't just assume that things will get done. Retitling of marital assets. Let's look at another situation. In this case, the client's new will and trust contains an elegant pecuniary formula that the surviving spouse is to receive the smallest amount of property necessary to reduce the estate tax liability to zero, taking into account the applicable credits. The balance of the estate passes to the family trust for children and heirs. Unfortunately, although the attorney did a great job of the document, they neglected to ascertain how the client's property was owned. As it turns out, a substantial portion of the client's wealth is reflected in residential and other real estate held in joint tenancy with rights of survivorship. If the client dies, the property passes not under the new estate planning document, but to the surviving spouse by operation of law. The result could be that the marital share is significantly overfunded to the point where the surviving spouse's estate is needlessly exposed to the estate tax at his or her death. In addition, the family share may be unexpectedly underfunded, with the children receiving less than was anticipated. Again, all of the client's advisors should be aware that not just the magnitude of the client's wealth, but the manner in which the property is owned. Checking beneficiary designations. In another situation, a client's will and trust provided for the tax-efficient distribution of wealth at death. However, no one bothered to determine the precise nature of the client's wealth. Although the client had substantial investment accounts and real estate holdings, The bulk of his wealth was stemmed from residuals from a highly successful business he owned and operated. How substantial? The discounted value of the residuals, which were payable over 20 years beginning at retirement, was upwards of $20 million. As it turned out, the spouse was the sole beneficiary of the residuals, which passed via a beneficiary designation the client had signed when he first started the business. None of that wealth would pass under the will and trust, but would instead be exposed to estate and income taxes at the death of the surviving spouse. Not exactly what the client had in mind. The solution lies in reviewing beneficiary designations on life insurance, IRAs, non-qualified plans, assets, and contracts like the one in the example. Make sure the beneficiary designation is coordinated with estate planning documents and reflects the client's intentions. Bottom line, a little planning can go a long way. Always have a plan for follow-up and execution in connection with the titling of your client's assets. Problems arise when no one person is accountable.
This podcast was brought to you by the Certified Wealth Strategist. If you missed a previous podcast or would like to learn more about the fastest growing certification in the financial services industry, please visit www.certifiedwealthstrategist.com.